All right, that jobs report out this morning. Yeah. Let's just call it a swing and a miss. Although January was an unexpected home run. So listen, it goes without question. The job market is changing. The labor market is changing in many ways. The question is, though, where does it go, and how fast does it get there? I want to bring in two of my favorite economists, FH and their financial chief economist, Chris Lowe, along with NatWest Markets, their U.S. head, Michelle Girard. Michelle, I mean, just sort of your initial thoughts on the jobs report, but also as it pertains, because almost all the economic data out for the last couple of weeks has been pretty good, some very good. So I was thinking the number would be better.
I laughed how you said, I guess that's kind of what my thought was at 8:30. You're right. I think that it's been the case, actually, that the employment data have kind of been the soft spot against the backdrop of an economy that has tended to be doing better, particularly if you look at GDP growth and both consumer and business spending. It's really been outpacing what we would be expecting when you look at the employment numbers. And let's look through the noise of the last couple of months. The bottom line is, over the last 3 months, over the last 6 months, you haven't really seen any job growth. I mean, the numbers are close to zero, right, in terms of average monthly changes. So we are certainly looking at an economy that is continuing to grow thanks to productivity, but the employment situation is lagging, and the question is, how long can that disconnect sort of last?
And to that point, Chris, I've been saying for over a year, been asking all the economists, is it oxymoronic or sort of far-fetched to believe we can have jobless prosperity? A nation where the stock market's doing well, housing's doing okay, productivity boom is there, corporations are making more money than ever, but fewer and fewer people are getting jobs.
Yeah, I think Michelle nailed it, right? This was a lousy employment report. January's was good. In fact, the job rise in January bigger than all of last year put together, but that in itself tells the story. You look at the longer haul, we're barely adding jobs in an economy that's growing faster than the Fed considers on trend. So what that tells you is enormous productivity growth. We are making GDP grow without adding workers.
To that point, and we just put a chart up there, we could put it back again, the impact of AI. So far, economists are telling me it's hard to quantify. Even Challenger and Gray, they don't have a lot associated with that. But you had the situation with Block laying off 40% of the workers because they could. Citrini report saying, hey, listen, the world has changed. Even the Iran attack, we were able to pull that off with 20 people, where a couple of years ago we would have needed 2,000 people. I mean, is the writing on the wall that the jobs picture has changed forever?
I think so. Here's one of those instances where I think Jay Powell describes it perfectly when he says this isn't just AI. The productivity boom goes back at least to the beginning of 2023. And I think it actually goes back about 25 years to the turn of the millennium. And that's, if you chart the level of GDP to the level of employment, you'll see GDP has been pulling away since then. So this is technology primarily being used in service companies to grow without people. And the pandemic just underscored to corporate management, we need to keep those labor costs in check.
So Michelle, then what does it mean? Go ahead. I'm glad you jumped in.
Well, I was going to say, but jumping in, the other thing, Charles, is on the other side of it, structurally as well, because of demographics, we don't have as many workers. So there's a couple of things going on. Productivity gains and or AI may mean that we need less workers, but that actually is in some ways allowing the economy to adjust to, over the next, it's been the case and will continue to be the case, that workers are going to be increasingly hard to come by, not only because of immigration, but over longer term with demographics. Right. So there is a balancing there to call out.
So then let me ask about right now, what's happening right now near term. Obviously, the price of oil continues to spike. Now, I've read that there's no real evidence of a long-term impact from these sort of things, but gas prices are going up quickly. And this is as we felt like we were on the cusp of 2026 really standing out. The one big beautiful bill, Michelle, a wind in our sails, people really having a chance to feel good. Is that going to be derailed, or when would that point come where you think, okay, all of that good stuff that was built in might be derailed?
Well, you're exactly right. Boy, we thought we had so many tailwinds coming into 2026. Of course, ultimately, the impact is going to depend on how long this drags out, how high energy prices go, and for how sustained of a period of time that is. But I think that there's an impact even in the short term around uncertainty, and I think that that was a big factor in 2025, contributing to firms being more cautious about hiring or replacing workers that were lost. That they're not laying people off, but they're not rushing to hire, and a lot of it was because of uncertainty around tariffs and how that would play out. Now we add another layer of uncertainty. First of all, the tariffs themselves, after the Supreme Court ruling, there may be uncertainty around that again. But on top of that, now the uncertainty surrounding the Iran conflict just gives businesses in the short term another reason to sort of sit on their hands. And so I do think, away from kind of the longer term impacts that we would normally be worried about, I think there's potentially a cool breeze that comes from heightened uncertainty around what we've seen over the last week and a half.
Yeah, I'm hoping that this is going to be short-lived. Maybe we can take control of the Strait sometime in the next week or so. And I think so. Oil comes down quickly, and this becomes maybe a less of an economic event. But this always circles us back to the Fed, particularly as we approach the worst Fed. I think Wall Street was comfortable with cuts in the second half of the year as long as the economy was being driven higher. Where does this put the Fed?
Well, if you look at what traders are saying, futures market had the first rate cut in July. That was a month ago. Today, they have it in September. So effectively, we're saying a 3-month delay. I think that's probably about right. Building on what Michelle said about both employment and the fact that the labor force growth just isn't there. And then on top of it, still another inflation surprise on the heels of a string of surprises for 5 years. The Fed cannot cut rates until they see lower inflation. They've made that point very clear. I think Warsh coming in, maybe he puts some pressure on them, but it's still a committee decision. And the committee is firmly circled around this idea. They cannot go until they see evidence of significantly lower inflation.
Chris, thank you very much. Michelle, thank you very much. Appreciate you both.
Thanks. Nice to see you.